Good day, everyone. My report is the continuation of the report of Erica, and I am going to start my report in methods of retiring debt. So the first method of retiring debt is serial payments. Bonds with serial payments are paid off in installments over the life of the issue. At sinasabi din dito na ang bawat bond ay may kanya-kanyang date of maturity and receive interest only to that point. The second method of retiring debt is the conversion. A more subtle method of reducing debt outstanding is to provide for debt conversion into ordinary equity share. So itong conversion can be exercised at the option of the bondholder. At dito din, there are number of incentives and penalties may utilize. So the third method is the call provision. Provides the firm with a flexibility to recall its debt and replace it with lower cost debt if interest rates fall. The terms of the call provision are provided in the indenture and generally state that the call price above bonds par value. The difference between call price and the par value is referred to as yung tinatawag natin na call premium. So the fourth method is the bond refunding. Bond refunding is the process of retiring an old bond issue before maturity and replacing it with a new issue. So nag-o-occur itong refunding when interest rates have fallen at yung bond may be sold at a lower interest rates. Dito rin sa refunding ay nagkakaroon ng overlap period wherein the new bonds have been issued and the old bonds have not yet been called. Kadalasan nagkakaroon ng overlap period dahil yung mga firms ay gustong mag-obtain ng funds from the new issue before calling the old bonds. So let us proceed with the illustrative case 19.2 Bond Retirement Decision. The following data are available for Malaya Corporation. A. 9% debenture bonds outstanding with 100 peso par value and 20 years remaining to maturity callable at 104, amounting to 50 million pesos. B. An amortized flotation cost and discount on the old bonds amounting to 3 million pesos. And C. Corporate tax rate 34%. The company is considering replacing the old issue with a new 50 million pesos, 8% 20-year issue and flotation cost of 2 million pesos. Additional issue cost of 400,000 would be incurred. The overlap period during which both issues will be outstanding is expected to be 1 month. Using the net present value, determine whether it is advisable to replace the old bond issue with the new bond issue. So dito, malalaman natin kung it is advisable to replace the old bond issue with the new bond issue. So here is the solution. The first solution, initial cash outlay, cost of calling old bonds 50 million pesos times 1.04 amounting to 50 million pesos. Proceed from the new issue net of flotation cost amounting to 48 million pesos. Then we will subtract 48 million from 52 million, we get 4 million pesos. Additional issuing expense bonds amounting to 400,000 pesos, interest expense on all bonds 1 month during overlap period, 9% times 50 million divided by 12, and we will get 375. We were going to add it to 400,000 and 375 pesos, then we will get 775,000. To get the gross initial outlay, we will add 4 million and 775,000, then we will get the 4,775,000 pesos. Then, we will less the tax savings on interest expense during overlap period amounting to 375,000 pesos, unamortized flotation cost old issue 3 million pesos, and call premium 2 million pesos. If we add the 3, we will get 5,375,000 pesos times 34%, we will get 1,827,500. So to get the initial cost, net initial cash outlay, we will subtract 1,827,500 from the gross initial outlay 4,775,000 pesos. Then we will get 2,947,500. Second is the annual cash benefit from eliminating the old bonds. Avoidable annual interest expense amounting to 4,500,000 less tax savings on tax-deductible expenses 4,500,000. Annual amortization of flotation cost 150,000, and we get the 150,000 from 3 million divided by 20. If we add the two, we will get 4,650,000 times 34%. We will get 1,581,000. Then we will subtract the two. 4,500,000 minus 1,581,000. We will get the net cash savings from elimination of old bonds amounting to 2,919,000. So number 3, annual cash outflow from issuing the new bonds, annual interest expense 4 million less tax savings on tax-deductible expenses, annual interest expense 4 million pesos, annual amortization of bonds discounts 2 million divided by 20, we will get 100,000 pesos. 4 million plus 100,000 pesos is equals to 4,100,000 pesos times 34%, we will get 1,400,800 pesos. To get the net cash outflow from issuing new bonds, we will subtract 1,400,800 from 4 million, then we will get 2,599,200 pesos. So number 4, present value of annual net cash benefits discounted at 5.28% for 20 years. So the solution is 2,919,000 pesos less 2,599,200 pesos times 12.171577. We will get 3,892,470 less PV of initial outlay 2,947,000. Net present value in the favor of the refunding of the old bond amounting to 944,970. So since the net present value of the refunding decision is positive, which is 944,970 pesos, the refunding proposal should be accepted. So let us proceed with the preferred share. Preferred share is a class of equity shares which has preference over ordinary or common equity shares. Preference means only that the holders of the preferred share must receive a dividend before the holder of ordinary equity share. So dito sa preference share, may mga preference na ibinibigay pagdating sa claims ng earnings at asset. Samantalang sa common equity share naman ay sila yung may mga last claim. So dito pa lamang makikita natin yung advantage ng preferred share sa common or ordinary equity shares. Halimbawa, kung sakaling magkaroon man ng liquidation o pagsasara ang isang company, mas unang babayaran ang mga preferred shareholders bago ang mga common shareholders. Kumbaga, mas nauunang bigyan ng dividend ang mga preferred shareholders. At kapag natanggal na sa earnings ang dividend ng mga preferred shareholders, ang matitira ang siyang paghahatian ng mga common shareholders. So next, the major features of the preferred share. The first major feature of preferred share is the par value. Par value is the face value that appears on the stock certificate. So itong par value is the principal amount that the lender is lending to the issuer or the borrower. The second is the dividends are stated as a percentage of the par value and are commonly fixed and paid quarterly but are not guaranteed by the issuing firm. So itong mga dividends ay ito yung mga binabayad ng isang company sa mga shareholders nito. So the third is the cumulative and non-cumulative dividends. Dividends payable to preferred shares are either cumulative or non-cumulative, but most are cumulative. So sa non-cumulative dividends, ito yung mga preferred stocks or shares that does not pay stockholders any unpaid or omitted dividends. While in the cumulative dividends, it is required dividends payments made by a firm to its preferred shareholders. If the firm is unable to pay dividend on time, they must accumulate sufficient funds until it can make the payment. So, the number 4 major features of preferred share is no definite maturity. Preferred share is usually intended to be part of a firm's equity and thus no definite maturity date. So, the fifth features of preferred share is convertible preferred share. Have the option of exchanging their preferred share for ordinary or common share. The sixth major feature is voting rights. So, dito pa lang muna sa convertible preferred share, ito yung mga preferred share ay maaaring i-convert into a predetermined number of common stock. Pero bago ito ma-convert, mayroong mga specified terms and condition na dapat gawin. For example, yung mga in preferred share, they specify the date and at which the share can be converted, while others require the approval from the board of directors before the conversion. So let us proceed to number 6 major features of preferred share, which is voting rights. Special voting procedures may take effect if the issuing firm omits its preferred dividends for a specified time period. So dito sa preferred share, the shares do not assign voting rights to their holders, but some preferred shares allow its holders to vote on an extraordinary event. Number 7, participating features. Participating preferred share entitles its holders to share in profits above and beyond the declared dividend. Number 8, protective features. Preferred shares issues often contain covenants to assure the regular payment of preferred share dividends. So for example, dito is yung mga covenants. They can restrict the amount of common share cash dividends or specify working capital levels and limit the sale of securities. Number 9, call provision gives the issuing corporation the right to call in the preferred share for redemption. Number 10, maturity. Preferred share has a sinking fund and thus have an effective maturity date. So before 3 days ago, it is said that most preferred share was perpetual, wherein it has no maturity date and never needed to be paid off. But today, preferred share has a maturity date. So let us proceed with the advantages and disadvantages of financing with preferred share. The first advantages is financing flexibility. So by using preferred share, a firm can fix its financial cost and thus keep more of the potential future profits for its existing set of ordinary equity shareholders, yet still avoid the danger of bankruptcy. The second advantage is favorable financial leverage. Issuing preferred share provides favorable financial leverage that enhances the ordinary shareholder's return if the firm earns a rate of return on its preferred share that is higher than its cost of capital. The third advantage is no dilution of control because by selling preferred share which lacks voting rights rather than ordinary share, the firm avoids sharing control with new investors. Number 4, no maturity because preferred share do not have to be repaid. The fifth advantages of preferred share is asset preservation because the corporation does not have to pledge asset as collateral when issuing preferred share. Number 6 is no equal participation on earnings because non-participating preferred share is limited to a stipulated dividend only. On the other hand, preferred share has its disadvantages. The first is high cost. Preferred share has a higher after-tax cost of capital than debt because preferred dividends are not tax-deductible expense, whereas interest expense on debt is deductible. The second disadvantages is seniority of the holder's claim. Preferred shareholders has preference over ordinary or common equity share in the payment of dividends and the liquidation of assets that may jeopardize the ordinary equity shareholders' return. So next, let us proceed with the formula of the intrinsic value of the preferred share. The formula is preferred share is equals to DP over KP, where DP is equals to per share cash dividend, and KP is equals to investors' required rate of return on preferred share. So let us see the example. Federal Electric and Power Company has an issue of preferred share outstanding that pays a yearly dividend of 10.80 pesos. Investors require a 12% return on its preferred share. Determine the extrinsic value of the preferred share. So here is the solution. Preferred share is equals to 10.80 pesos divided by 12%. So we get the intrinsic value of the preferred share, which is equals to 90 pesos. Next is the ordinary or common equity share. Ordinary equity share is a form of long-term equity that represents ownership interest of the firm, while ordinary equity shareholders are the true owners of the corporation and consequently bear the ultimate risk and rewards of the ownership. So since the mga shareholders are the true owners of the corporation, they are also the one who need to bear the risk and also the rewards of the ownership. So yung tawag dun sa mga shareholders ng ordinary equity share ay sila yung mga residual owners. So let us proceed with the features of ordinary or common equity share. First is the par value or no par value. Ordinary equity share may be sold with or without par value. Whether or not ordinary equity share has any par value is stated in the corporation's charter. Par value of ordinary equity share is stated value attached to a single share of issuance. A firm issuing no par share may either assign a stated value or place it on the books at the price at which the equity share is sold. The second features of ordinary equity share is authorized, issued, and outstanding. Authorized share is the maximum number of shares that a corporation may issue without amending its charter. Issued share is the number of authorized shares that have been sold, while the outstanding shares are those shares held by the public. So the third features of ordinary equity share is no maturity. Ordinary equity share has no maturity and is a permanent form of long-term financing. Although ordinary share is neither callable nor convertible, the firm can purchase its share in the secondary markets either through a brokerage firm, a tender offer. Number 4. The fourth feature is voting rights. Ordinary equity generally entitles the holder to vote on the selection of directors and in other matters. Shareholders unable to attend the annual meetings may vote by proxy. A proxy is a temporary transfer of the right to vote to another party. So, proxy voting is done under the rules and regulations of the Securities and Exchange Commissions. So, the voting rights has two common systems. That is the majority voting and the cumulative voting. Majority voting is a voting system that entitles each shareholder to cast one vote for each share owned. On the other hand, the cumulative voting is a voting system that permits the shareholder to cast multiple votes for a single director. So, the only difference ng dalawa is yung sa majority voting, they need only to cast one vote, while on the cumulative voting, they need to cast multiple votes. So, the fifth features is the book value per share. Authorized share is the maximum numbers of share. The accounting value of ordinary share is equals to the ordinary share equity divided by the number of shares outstanding. So, yun yung book value per share. Number 6 feature is that numerous rights of stockholders. So, ito yung mga rights ng mga stockholders sa ordinary or common equity share. So, the first is the right to vote on a specific issue, the right to receive dividends, right to share in the residual assets, right to transfer their ownership in the firm to another party, right to examine the corporate banks, and the right to share proportionally in the purchase of any issuance of equity shares. So let us proceed with the comparative features of ordinary equity shares, preferred shares, and debt. So dito, pinapakita lang yung pinakang summary kung ano yung pagkakaiba at pagkakapare-pareho ng ordinary shares, ordinary equity shares, preferred shares, at saka bonds. So, letter A, the ordinary equity shares when it comes to ownership and control of firm is that belongs to ordinary equity shareholders through voting right and residual claim to income. So in preferred shares, the ownership and control of the firm is limited right when dividends are missed. And in bonds, the ownership and control of the firm is limited rights under default in the interest payments. So the obligation to provide return when it comes to ordinary equity share is none. There is no which means there is no obligation to provide return. So in preferred shares, the obligation to provide return must receive payment before ordinary shareholders. And in the bonds, the obligation to provide return is contractual obligation. So contractual obligation is wherein the two sides has both obligations with each other. So company has a contractual obligation to perform work or provide services to another entity. On the other hand, the bond guarantees that the individual or company will fulfill the terms of the contract. So that is contractual obligation. So the third, claim to assess in bankruptcy in ordinary equity shares. They have the lowest claim of any security holders. In preferred shares, the claim to assess in bankruptcy is bondholders and creditors must be satisfied first. In bonds, they have the highest claim when it comes to claim to assess in bankruptcy. So next, cost of distribution when it comes to ordinary equity shares is the highest. In preferred shares, the cost of distribution is moderate, and in bonds, the cost of distribution is the lowest. When it comes to risk-return trade-off in ordinary equity share, they have the highest risk and highest return. In preferred shares, they have the moderate risk and moderate return, and the bonds, they have the lowest risk but moderate in return. So tax status of payment by corporation in ordinary equity share is not deductible. In preferred shares, the tax status of payment by corporation is also not deductible. While on the bonds, the tax status of payment by corporation is deductible, wherein we will get the cost which is equals to interest payment times 1 less tax rate. So letter G, tax status of payment to recipient in ordinary equity shares. A portion of dividend paid to another corporation is tax exempt. In preferred share, the status a payment recipient is same as ordinary shares. So in bonds, the stock status of payments to recipient government bond interest is tax exempt. So let us proceed to the advantages and disadvantages of ordinary equity shares over the preferred shares and bonds. First is no mandatory fixed charges. Ordinary equity shares does not involve mandatory obligation to pay dividends. Thus, ordinary equity share is less risky to the firm than fixed income securities. Next, the second advantage is no definite maturity date. Unlike debt, ordinary equity share is permanent source of long-term financing. Hence, the lack of maturity eliminates future repayment obligation. The third is potentially greater ease of sale. Ordinary equity share may be easier to sell than debt or preferred share, particularly when the firm has a rights offering or more than an optimal amount of debt in its capital structure. Number 4, increased creditworthiness. The firm's ability to issue more debt is enhanced by ordinary equity share because its leverage position is reduced. Number 5, avoidance of restrictive provisions. Issuance of ordinary shares gives the firm more financial flexibility because they usually do not contain any of the restrictive provision associated with debt and preferred share financing. So, number 6, advantage. From a social viewpoint, ordinary equity share is a desirable form of financing because it makes business less vulnerable to the consequences of declines in sales and earnings. So the disadvantages, number 1, dilution of control and earnings. A new issue of ordinary equity share may result in the dilution of existing ownership and control because new ordinary equity shareholders have voting rights. Number 2, the higher issue cost. The flotation or issue cost of new ordinary equity share are generally higher for either debt or preferred share. Number 3, disadvantages causes increase in component cost of capital. So the cost of capital associated with ordinary equity share is higher because dividends are not deductible for tax purposes and because ordinary equity share is a riskier security than either debt or preferred share. So that is the end of my report.